Coming up on today's show, International Monetary Fund to provide $50 billion in emergency facilities to low-income and emerging market countries to mitigate economic shocks of the coronavirus. And Moody's Investor Service commends the Bank of Ghana for reducing its benchmark lending rate and other risk mitigating measures against COVID-19. Plus, South African Central Bank launches bond buying program as the COVID-19 epidemic weighs on the country's already ailing economy. We're glad to have you on the program. I am Bisi Adebayo. But let's hit the markets right away, starting with intraday numbers coming from the African markets, where all the numbers are in the green at intraday. Here in Nigeria, the all-share index was up 0.73%, while the JSE index in South Africa was 3.34% positive. In Egypt, the index was up 0.55%, also at intraday. The Kenyan Burse closed down 0.19% on Wednesday. But it's a different scenario in the Middle East as the major markets we track in that region were all in the red at intraday, except in Saudi Arabia. In Abu Dhabi, the index was down 3.84%, while the Dubai FM was 0.76% negative as at intraday. The Qatari index was also 0.65% negative. The Saudi Tadawul was the only index in the green, up 1.90%. And European markets retreated today as global market sentiment soars once again amid the coronavirus outbreak. Investors are also monitoring the release of U.S. initial jobless claims data expected to be out today, which could provide clues to the economic impact of the coronavirus pandemic. Let's talk to Chelsea Delaney for more updates on this. Good afternoon, Chelsea. The European Central Bank is abandoning its self-imposed limits of bond purchases for its emergency coronavirus aid package. How are investors reacting to this?
Well, this is certainly a historic move on the ECB's part. They have been buying European government bonds for several years now. This really helps drive down cost for governments and for companies and countries to borrow. But with this new change to their rules, they're going to be able to buy an unlimited amount of bonds for each country. In the past, they had been constrained by this rule that only allowed them to buy about 30 to 33% of a country's bonds. They've been running up against that limit for a lot of countries. And now that the Eurozone is facing this tremendous economic crisis, there's been a lot of concern about what they were going to do once they could no longer buy government bonds of a country like Italy that's really facing a dire economic and health situation. They need to be able to sell bonds at cheap rates so that they can fund these stimulus measures. So the ECB has removed that impediment. In terms of the market reaction, we've seen a really dramatic move in government bond markets today. We've seen Italian bonds, Greek bonds, and Portuguese bonds in particular rise a lot as investors feel a little more secure about the economic situation in these countries. That's driving yields down and suggesting that these countries will have an easier time borrowing money to tide themselves over through this crisis.
A survey by the GfK Consumer Research Institute showed that German consumer confidence fell to its lowest level since the financial crisis in March. What does this mean for the German economy?
It's another really ominous piece of data for Germany and the broader Eurozone. We're really just now starting to get a read on how this is impacting the economy. Earlier this week, we had a survey that showed Eurozone economic activity at its lowest level ever, according to these surveys. Now this data on German consumer confidence is also just signaling a huge decline in consumers' willingness to spend. This survey also only took place from March 6th to March 14th, March 4th to March 16th. That's before the broad majority of the lockdown measures in Germany took place. So that also suggests that the declines in next month's survey are going to be a lot steeper. But this does paint a really grim picture for the German economy, which has been really dependent on consumer spending over the past several months. That's really been the only driver of economic growth. Now with that out of the picture, economists are looking at a potential contraction in the economy of something like 10% for Germany this year.
Let's talk about European leaders now warning that foreign investors could try to buy up critical European companies as COVID-19 rolls the economy. But what are these concerns coming from?
Well, these concerns have been around for a while. Even before coronavirus, there's been a global anxiety about, in particular, Chinese firms or the Chinese government and its affiliated companies buying up, for example, European companies or American companies. This is all really being brought to a head right now through this coronavirus crisis because, for one, we've seen just massive declines in the market value of companies, so they're looking quite cheap right now. But we also saw the U.S. administration make an offer for CureVac, which is a German company that is developing a coronavirus vaccine. They offered about $1 billion for this company. That was really taken not so well here in Germany. It was sort of seen as the U.S. trying to sort of buy this vaccine for themselves, and now there's really a lot of response from European governments to try and prevent other buyers from coming in and scooping up companies that are cheap or are making really critical medical equipment or is really important to technological infrastructure. We have seen Germany, for example, set aside about 100 billion euros to buy stakes in companies that are really depressed. Their market value is really depressed right now to sort of help them get through this without making them a target for other buyers. We've also seen Italy, France, and the broader EU Commission talk about strengthening provisions that would allow them to veto purchases like this if a foreign buyer does come in and try to make a hostile takeover approach. But this is also raising concerns about increasing nationalism in EU economic policy.
Many thanks, Chelsea. We'll see you again tomorrow. Let's cross over now to the UK, where the FTSE 100 was down as much as 2.16% earlier on as the COVID-19 impact continues to weigh heavily on businesses. Juliana Olayinka is standing by to give updates. Good afternoon, Juliana.
Good afternoon, Bessie.
The London City Airport is shutting down to both commercial and private flights through the end of April. Of course, that is due to the coronavirus crisis. But this is more problem for the aviation industry, right?
It is more problems, and we know, Bissy, that the aviation industry has been left reeling since lots of countries closed their borders. We heard from a couple of them just last week saying, particularly in the UK, that they would need an immediate payout of billions if many of them were not to go under. We did hear that over the weekend, the Chancellor of the Exchequer, Rishi Sunak, did write to the industry and said that, they shouldn't expect a bailout from government, that a bailout would, of course, be in talks, but they should instead go to their wealthy shareholders. Well, since that letter was leaked yesterday, London City Airport did make the decision to shut down the airport, no longer allowing any commercial or private planes flying into their space. London City Airport is quite important, really pivotal in terms of where it is. It's based just to the east of London, but really popular for people that like short-haul distances and even long-haul distances. Their chief executive last night in a statement did say that it was for the best welfare for all of their staff and all of their passengers. But really, considering that the amount of planes coming into the airport were down 80%, one does wonder whether or not it was a commercial reason instead.
And as people work from home, Juliana, of course, there's a high tendency to consume more food this period. How are food supply networks coping with a high demand caused by this issue?
Well, it's an interesting point, actually. Of course, I suppose, if you're watching this from home, you're probably trying not to eat out your house, but that's exactly what people are. And of course, food distribution has been a major talking point, not just in the UK, but in most places that are in lockdown, because a lot of people have been stockpiling. I've listened to a lot of reports that are coming from the places that are worse hit in China, in Italy and in Spain. And a lot of media there are saying that there is enough food if people just don't panic buy and buy more than they should need, which is still a major issue here in the UK. Even as London is under lockdown, there are still vast queues of people queuing up. But the government have, of course, now written to supermarkets. So most people are not able to take more than one or two of those longer shelf life items. But now the conversation has shifted, Bissy, into logistics, because most of the food in somebody's fridge or in their cupboard in the UK doesn't come from here. It comes from overseas. And although, of course, essential work is still going on and there are flights that are still bringing in food and ships that are bringing in food, the amount has started to decrease. And we know that there will be a G20 meeting happening later over the phone. And I think world leaders are really going to discuss this. But yes, logistics and operations, should this COVID-19 last much longer than anybody expects, will dominate discussions of just how some countries who depend on other countries for food will be able to feed their nations.
I'm sure everyone is hoping that this doesn't last longer than expected. Of course, Juliana, do remember to always stay safe. We'll see you again later. And moving on now to Asia, where shares in Japan led losses among the region's major markets, with the Nikkei 225 falling 4.51% to close at 18,664.6, while the Topix index shed 1.78% to end its trading day at 1,399.32. Mainland Chinese stocks slipped, with the Shanghai Composite 0.6% lower and the Shenzhen Composite shedding 0.799%. Hong Kong's Hang Seng Index also slipped 0.72% as at its final hour of trading. South Korea's Kospi finished its trading day 1.09% lower at 1,686.24. Meanwhile, the S&P ASX 200 in Australia rose 2.3% to close at 5,113.30. And in the U.S., stock futures were also down early this morning as investors look ahead to the National Weekly Initial Jobless Claims data expected later in the day. Dow futures indicated an opening drop of more than 300 points at Thursday's open. S&P 500 futures and Nasdaq 100 futures also pointed to opening losses. Away from the markets now, the International Monetary Fund has promised to provide $50 billion in emergency facilities to low-income and emerging market countries to mitigate the economic shocks of the coronavirus, including $10 billion in concessional loans. The Washington-based fund says the spread of the coronavirus into sub-Saharan Africa will hit the region's economic growth hard, with direct disruptions to people's livelihoods, tighter financial conditions, reduced trade, and a steep drop in commodity prices. The fund's Africa department says there have been requests for emergency financing from over 20 countries in the region and expects at least 10 more soon. On Tuesday, the IMF announced that Ghana had requested a rapid disbursing emergency loan to fight the coronavirus pandemic. And there's more coming from the IMF regarding the COVID-19 crisis. And this time, the fund says with oil prices down 50% since the start of 2020, the impact on oil exporters in Africa will be substantial. The fund estimates that each 10% decline in oil prices will, on average, lower growth in oil exporters by 0.6% and increase overall fiscal deficits by 0.8% of GDP. Nonetheless, the IMF recommends increased fiscal spending first on public health, but also to provide broad economic support, including cash transfers to individuals and households under strain. Still ahead on the program, a focus on the domestic commodities market. Please stay with us.